All right, thanks everyone for joining today. We have James Zing, Paul Peoples, James Wilson, Julie Peterson with Old Capital on, and we've got a whole bunch of other people joining us here tonight. So we're going to kick it off with a little bit of an intro of what Old Capital does, and then we're going to get into the market, what we're seeing sort of in the past, whether it was in Texas and across the nation, and then really get into what we're seeing today. And then we're also gonna have Neal come on in about 30 minutes and tell us about capital calls in terms of 101. And then we'll have some networking at the end. We'll do some breakout sessions, things like that. So Old Capital did 1.2 billion in 2022 across the nation. Here are some sample transactions. The first quarter, we were at about 160 million in loans, so 1,700 units. And then, in terms of, we just had our bowling event. Thank you for all the sponsors. I see Jeff King here, a lot of sponsors and a lot of people there at that event. So I appreciate everyone coming out to that. And then, all right, so a couple ways to connect with us if you have not worked with us before. Is to number one, the podcast, Old Capital Podcast. If you have not heard our podcast, go on to iTunes and subscribe to that. We try to do every Tuesday. The last month, we've tried to go live on YouTube and LinkedIn, so you can join us live. And then Julie has a Zoom at 8 on Tuesdays at 8 p.m. Eastern. So if you have not joined that, join that as well. All right, and then our big event is October 4th and 5th here in Dallas. 500 of our closest friends will be here in Dallas for that event. So if you have not bought your tickets, go to oldcapitalconference.com and you can get more information on that event. All right, all right, Paul, are you there?
I am here.
All right, let's go then.
Okay, so what I wanted to talk about before Neal got on, and I did this presentation last week, and I thought it was a good presentation. I made it up, but as everybody knows, I've done this this is my 38th year of doing it. And I want to kind of share with you some of my feelings about what I see of going on today that has been similar in the last couple rounds. And I kind of want to phrase this is yesterday, today, and obviously tomorrow. Yesterday, today, and tomorrow. So if we go to the next slide, and James is in control. And so, how did we get here? And so a lot of people just don't understand banking and some of the cycles that go on. So I'm going to kind of walk back a little bit of what my impression has been over the last, say, 35, 36, 37, 40 years. So if we go back, and I'm going to probably walk through this fairly quickly, and then you guys we'll send out the slides if you want to see this. But again, this is my impression of what's going on. So we go pre-1986, and I'm talking about 81, 82, 83, or 4. President Reagan gets in to office, and he institutes a bunch of tax cuts. He decreases social spending, obviously, increases military spending. We're putting that war machine back together. But his big thing is market deregulation. If you remember AT&T and the airlines, and they were all deregulated. Well, one of the things that they also deregulated was the savings and loan in the banking industry. And we'll talk about that in a second. So if you weren't around in 1981, and a lot of people on this call probably were not around, or they weren't really paying attention, we had huge amounts of inflation, not so much like it is today, but twice or 3 times what it is today. Federal funds rate was at 20%, not at 5 or 6%. Prime rate, which is at 8.25%, was at 21%. And the philosophy here in Texas was build it and they will come. So we had, again, a huge amount of inflation, and interest rates rose both dramatically in the 1970s and the early 80s. And this produced really 2 problems for the S&L. And this is something that you may not realize, but the S&Ls were regulated by the federal government on what they could pay deposits, and they were substantially below what they could be earning elsewhere. So people were starting to take money out of the savings loans. In this case, just like Silicon Valley Bank or Signature Bank. And the way that savings loans were able to compete were like toaster ovens and bathroom scales and everything you can remember that your mom or your grandpa got from the savings loans as gifts just to compete because they could only be paying X amount in a rate, and that was government required. Well, people were drawing money out, and so the Reagan administration said, "Hey, listen, we're going to deregulate you guys." And so when they deregulated, and that was the Garn St. Germain Depository Institutions Act, which they were dealing with the rising inflation, and everybody wanted to get higher deposit rates. That means the lenders had to go into more crazy things to invest in. So, so they had to pay higher deposit rates. And I know I saw Steve Smith on this call because he's an old guy, so to speak. Is the savings loans got into things like that they had never gotten in before. Because if you remember, savings loans were kind of the Wonderful Life with Jimmy Stewart. They lent money to your mom and dad and your cousins and your brothers just on homes, and that was it. They took money in from little old ladies and your aunt and your uncle, and they lent that back out into the community itself. And that's all they did. But once they deregulated, they had to pay higher deposit rates. And when they paid higher deposit rates, they had to earn higher rates. And so what they got into was land development and oil and gas leases and airplane loans and apartment developments and all kinds of different things that they got into to pay higher rates of return for deposits. And unbelievable that unbelievable amount of things that were going on during that period of time. So these people were only focused on savings loans, but they got into all these crazy investments, and there was kind of a moral hazard that was coming on around that period of time. That they were like a lot of these savings loans were run by rogues or incompetent people, and we found that fraud was about 60% of a lot of these transactions that were going on. So they got into things that they never had gotten in before, and it was crazy. So these thrifts blew up. So the industry blew up by 56% from 82 to 85, twice what the banks were. And a lot of these loans, as you can remember, they were betting on the come, so to speak. So they were, lending short and borrowing long, or borrowing long and lending short. So it is unbelievable what they had gotten into, and they were just upside down in these deals. And so it was a flip of coin. Heads the shareholders win, and tails the taxpayers loses. If the loan officers and the banks, savings loans banks, were investing in these different projects. Let's go to the next slide, James.
So were these guys private at the time in 82, or were they public?
No, they were publicly held companies, the savings loans.
But not owned by the government, not owned by the government.
They were not owned by the government. So the government came in and they deregulated the savings loan industry itself. Okay. And they allowed people to invest, allowed depositors to have their money invest into these crazy, wacky things that they had never lent before on. And so in 1986, there was a Tax Reform Act. People remember that they said that they had to take they were receiving passive activity losses and limitations. So it means that a lot of these properties were built to take tax losses. And so they removed the tax shelters, especially for real estate investments. And what that means is that when people started to build these things, they were building these properties, these commercial real estate land development deals for a loss, not for a gain, but for a specific loss. Because if you earn $60,000 a year on your W-2 job, you were able to and you lost $10,000 on the deal, you were able to take the $10,000 off the $60,000, and then you got taxed on the $50,000. So when the Tax Reform Act of 86 said you can't do that anymore, then the apartments had to be built and run for profit. And that's like some of the stuff that we're going through today. And some of the savings loans and the banks failed on that because they were, originally set up to invest in transactions that were losing. So when they started to lose, and a lot of these banks that were taking over, the savings loans that were taking over back in the late 1980s, they implemented a thing called FIREA, which stood for the Financial Institutions Reform and Recovery Enforcement Act. That was the S&L bailout at the time. And a lot of these regulators went belly up. They had just no money, no net worth on some of these savings loans or banks. And so the Office of Thrift Supervision took it over, and the RTC they were kind of like the asset managers. So if a property did not was not earning income and the keys were given back, the lender was insolvent on these a lot of these deals. Government took the lender over, and the RTC is the one that was the asset manager that had to figure out how to sell this asset, or asset management, meaning that when's the grass going to be cut, who's going to manage it on behalf of the tenants, what happens if the tenants have a problem, or there's leaks. RTC were the people that were going around and making sure these properties were working. And I'll talk about that in a second, but over a period of time, RTC closed over $407 billion in savings loans in the 1980s, going into the early 90s. And then the cost of the taxpayers was about $125 billion. And that was the FIREA was the one that really was the reform of the legislation that got us out of having these thrifts do these crazy stuff up until 2008. So let's move on. And then Texas was the kind of, what's that?
Go ahead.
Texas was the epicenter. So when I moved from California to Texas, there you go, Charles Lemaire, Danny Faulkner, you got that right. So a lot of these guys that got into, a lot of these guys that were developers. So think of Danny Faulkner, who was a painter. He's the guy who painted Texas Stadium for the Dallas Cowboys. He painted that. And so there's a guy named Don Dixon, and Don was a developer, and he had some money, he had some net worth, but he'd go with his hat in his hand down to the bank and ask for money to fund one of his projects. And what happened is that the lender says, no, we're not going to do that for you. It's too much risk. We're not going to do that. So when they deregulated the savings loans in the banks, he said, I'm going to buy myself a savings loan. And so that's what he did, is he bought Vernon Savings. He brought it from Vernon, Texas to Dallas. And he set up the operations over in Addison. In fact, they were hungry for so much money to come in on deposits that he set up a depository, like a banking center at Addison Airport. And he would fly a 737 out to San Diego in Orange County once or twice a week, take money from depositors and bring it back out of California to Texas, because we had an insatiable appetite to continue to build stuff in Texas, and we needed depository money to continue to feed that piggy bank. So when he got in there, there's a lot of buildings that Don and his group built, and they were all taken over by the government. But one of the things that we were trying to put people back to work, a lot of the trades, the roofers, the plumbing, the electricians that were building these apartment buildings to get the economy going, because we were in a recession. They built a ton of apartment buildings. And one of the things that they built was a thing called the I-30 corridor just east of Dallas. And that was a huge deal. And people don't remember this, but they should. But all those buildings on I-30, all the way from, say, TI, all the way out to the lake on I-30, a lot of those buildings had to be destroyed because they were halfway built. They weren't earning any money. The people were defaulting on the big mortgages. And so the next slide shows you what the RTC had done. So they came in and they destroyed condominiums and apartment buildings. They destroyed thousands of apartment buildings that were either completed, but nobody showed up to rent it out. So they put steel fences around it. They found it was a lot more expensive to maintain these deals than to destroy them. So they destroyed them with these places going through, and they would catch them on fire and burn it, and so they wouldn't have to maintain them over the period of months and years and waiting for this thing to come back. So thousands of apartment buildings were destroyed at that period of time on the I-30 corridor. So again, let's go to the next slide. And so then now 2007, 2009 comes, and we have this global recession. Again, we're starting to have a little bit of a theme that we have this huge run up, and then we get re-regulated type of stuff. So, the rise of subprime lending was kind of one of the big things in the global financial crisis here in the United States, on the residential side. It was all due to structured financing. And so if you go back to prior to 2008, we had incredible political pressures on the residential side for trying to get people that had no jobs, no income, no money for the down payments. They wanted to buy a house, and the US government was like, let's go, let's buy something. And what happened is the investment bankers kind of took it over and said, hey, listen, we were able to package these deals up and we can sell it to different countries and different areas that want to buy this stuff because, US real estate never goes down. So again, they couldn't qualify for personal income and they couldn't qualify based on their credit, but we can give you 100% leverage based on, you telling me in the future that you're going to earn more money, and we'll give you this, say this $300,000 loan. And it was all structured. It was not really bankers that were underwriting these deals based on your credit like they have to do it today, but it was all structured type of deals because they were betting that when you bought the property here, that it was going to go up even higher. So then boom, values fell by, in California, 41%, but the nation hit 30% of a decline. Texas was not that badly hit because we had the Homestead Act, and at that period of time, it was difficulties to take cash out of these properties. But a lot of properties in these different states, they had lax rules about pulling cash out. They were like ATM machines, and then people were pulling money out and living off their cash flow of their house all the time. So the mortgage-backed securities was the big thing where they were pulling all these things together to sell them in pieces and tranches. The rating agencies were out there, but they were useless. Lehman Brothers failed, Bear Stearns failed, Countrywide failed, obviously, in this area. And one of the things I want you to do if you ever have a chance, go to ML-Implode, and it shows you all the lenders between, say, 2008 to 2011 that blew up. And these are like the residential lenders. And then in 2009, 11 or so, we had the Dodd-Frank Act that came in and said, really, we're going to re-regulate the industry again. So we need the CFPB, the Consumer Finance Protection Board, that you have to have credit and income to qualify for these days. You need credit, all kinds of stuff. So let's go to the next slide. So they kind of
yeah, Paul, I was listening to this interview with Howard Marks, and I think he mentioned how many AAA rated companies are there in the world? Like 3.
I don't think very many.
Yeah. And then, but how many AAA rated loans are there?
Well, these were all structured transactions.
Exactly.
So
there's thousands, like, hundreds of thousands, whatever it is, tens of thousands. But you can invest in them the same way. Right. So if you're a company, you can invest in AAA rated companies, or you can invest in AAA rated loans. So, all right, keep going. All right.
Yeah. So just like that guy put salt on the steak, that was all hokey Finoki type of stuff on the credit rating agencies. So this is kind of a history for the last, say, 60, 70 years or so of where rates are and short-term rates. Now we can see on the right-hand side, that's where we're at today. And for the last, say, 10 years, it was pretty flat. But if you go back to 1981, 82, I mean, I was around where interest rates went up 5% in one day, 5% in one day, right there, trying to slow the economy down, and that's kind of threw it into a recession with Paul Volcker. But the average interest rate over a period of let's say 60 years is what, 8%, just eyeballing it, I mean, who knows? Maybe it's 7.5, maybe it's 8, but it's not really 20%. I mean, that's kind of an anomaly. And for the last 30 years, they've been able to keep the interest rates down. I don't think it's going to spike up to 17, 18%, but God forbid that happens, but it's 8%. So I see rates at right now at, 6%. I mean, that's free money still. Let's go to the next page. So again, apartments, and how did we get there? So prior to 2000, when people bought apartment buildings, there was 3 rich guys or gals, and it was three rich guys only. And only 10% of the people that are buying apartments, they were syndicators. 10% was syndicators, 90% were rich guys. Now these properties were a lot cheaper than they are right now. So 3 rich guys or gals, it was the builder, his brother-in-law, and the rich guy or so that were buying these apartment buildings for $3.5 million. There was no educators, no mentors. There were no syndicating groups together. So in Dallas, if you were here in the 1950s and 60s, They built apartment buildings in the central business district of 50 units or less. These were like kind of like home builders that were building these properties. And then in the 1960s, they expanded out, and then these became production builders a little farther out, but kind of economies of scale, they went from 150 to 200. And then after that savings and loan thing happened from 87, 92, there was no building going on. There was no lending. There was no demand for apartments. And so that's where the donut hole is in apartments from 87 to 92. And then from 93 to 2023 today, everything is these big merchant builders that, they build it and then they sell it to somebody else. They don't usually hold on to it, but they're building properties of 400 units or so, because that's where it's cheaper to stack these high density properties. So back in the 60s and 70s was really workforce housing. That was in 80s, that was being built and what was being bought by investment groups. They were looking for more stabilized immediate cash flow. They weren't looking to try to put dollars into it to try to get a capital gain. And they were financed by Fannie Mae and Freddie Mac and banks, and they would own them for 5 to 10 years. So they weren't in and out for a short period of time. They owned them for 5 to 10 years, and they were happy with the cash flow that the rents gave off. Let's go to the next page. And this is kind of post 2010. This is where a lot of people have gotten into this deal. That 10% of the three rich guys, now it's 90% syndicators. And it's just 3% or three rich guys in the 10%. Now to try to buy a 25 or $30 million property, it's almost damn near impossible. You don't have enough equity from the three rich guys anymore. So it's really the syndicators. And then everybody that previously closed one deal, they became the educator or mentor. And so that's where this education mentoring stuff goes on. And the people who were buying were engineers and professionals, and your brother-in-law and doctors. Those were the ones that were putting money into it. They weren't really real estate people. They did something else and they got converted to being real estate people. So where did they buy? They bought everywhere, and they bought a lot of rougher properties in class B minus C, and they tried to update these properties with that $5,000 budget of rehab on the deal. And they were only looking for value added, because they wanted the capital gain without the current pay. They were expecting something after they owned it for 2 or 3 years to be able to sell it at a higher price. And a lot of these deals were done by Fannie Mae prior to 2010. And then after 2019, they were done by bridge loans, non-recourse bridge loans or adjustable rates with this interest rate cap that was on it with 3 + 1 + 1. And they only wanted to own it for 3 years. They didn't want to own it for 5 to 10 years. They only wanted it for 3 years. And they needed the 22% IRR, because that, oh, you got 22%? I got 23%. But they didn't understand the risk with the structure. Was there a higher risk with doing a Fannie Mae or Freddie Mac loan, or a higher risk doing a bridge loan? People who got into the business didn't really understand the differences. They just were focusing on what this was going to pay me on my money. Let's go to the next slide. So what's going on today? Just a couple bullet points, and you guys can kind of go through this. Transactional volume is down 80 to 85% from just 12 months ago. Rental growth is slowed, but it's still positive in most markets. It's positive here in the Dallas-Fort Worth area. It may not be 15 or 16 or 17%, but maybe it's 3 or 4%. And that, Fannie Mae right now is the lender of choice. The rates are between 4 3/4 to 5 1/4% for these stabilized properties. Average term on these loans, 7 years with a yield maintenance to a step down prepayment penalty. So if interest rates were to go down, you could get out of them easier, and your prepayment penalty probably wouldn't be so severe. Let's skip down to H. There are still bridge loans out there at adjustable rates and fixed rates. ARMs are usually SOFR, which is at 5% plus a 450 spread. So what's at 9? And if you wanted to not buy an interest rate cap, you could go a fixed rate at 9 3/4. So that's what the rates are right now in lending. Regional banks right now are not lending very much, and a much lower leverage, and there's really no construction money for new properties. But when I was driving up to Frisco or Plano on 121 the other day, I was looking at all these cranes that are building all these properties. Those deals were done, approvals were done a year and a half ago, 2 years ago. They're just getting going today. So there's going to be a big donut hole where these deals are not going to come out of the ground for 2 or 3 years. And so that's maybe is something we can talk about in a second here. So values are down, cap rates are up. We're off 15 to 20% off of our highs. Institutional buyers are not buying. And there's a lot of bridge loans that are coming due, like $1 trillion. And again, investors fail to understand the risk versus return of, what's the 22% IRR? Is it the same on every structure? It's not. Let's go to the next page. This is the story that everybody knows. This was the foreclosure that was heard around the world, really. And one of the things that if people came to our presentation last month when we had the property managers, I made a point saying that Jay Gavinelli, who a lot of these people know, bought this property down in Houston, just closed in March of 2022. It was later, it was foreclosed. A lot of the investors that had common equity into the deal lost all their money into the deal. In fact, Arbor, who made the loan, they lost about $32 million in below the loan amount that they had originally done. So everybody lost on this deal on these properties in Houston. What I make as a joke, which is really not a joke. I mean, this Jay would only lease these properties out on a yearly basis, or to a tenant on a yearly lease, and that was great. But he found a way to try to lease them out on a shorter term basis. I mean, I'm talking about a real shorter term basis. And so this is what the city of Houston put up in front of his buildings. Solicitation of prostitution is a felony. And this is a real orange sign that's in front of one of Jay's properties. And so, so he brought it from being yearly rentals to being hourly rentals. Let's go to the next page.
Let's go to the next page.
So what do I believe? Again, my experience, dollar cost averaging into the market. So, I think, obviously we're down from the highs, but I don't know how much farther down we're going to go. I think we're going to go a little bit farther down. So dollar cost average in the market, everything's on sale right now to a certain extent. Invest with good operators, not their first rodeo, so to speak. Have enough liquidity for a rainy day. Obviously, take the shorter term fixed rate loan if you can do it with Fannie Mae. Continue to maintain the asset. Do not continue to pay distributions. I don't think anybody is right now. Continue to put in the property, maintain the asset. Obviously, buy in good areas, and then demand from your GPs to overly communicate right now. Everyone feels scared, so to speak. So we want to make sure the GPs are overly communicating about what's going on. And then just like what I showed before, take the long-term approach to investing in real estate. Just don't take the 2 or 3 year approach to it. You will lose, because I just never know when interest rates go up or things go down. I just don't know. Let's go to the last slide or two, and then we'll start with Neal in a second here. So this is what I believe in the reason why I'm heavily still invested in multifamily like you is that I take the long-term perspective in real estate. So commit to what you believe in and remain committed. Believe in the American economy and remain invested. So here are some critical dates in the United States. 29, December of 41, October of 87, September 2001, of course, March of 2020. And you kind of all know what happened on those days, but March of 2020 is when the pandemic started. And so, these were the months that shocked America, but it did not shake the American confidence. So bet on America, take the long-term perspective. Because remember, we're buying alternative assets. We're buying hard assets, not paper assets that can go up and go down much more rapidly than this. Let's go to the last slide here. I think it's the last slide. Maybe it's more one. But again, if you invest short-term, it could be challenging. If we have these loans at these maturities that are only for 2 or 3 years, it's going to be challenging because interest rates will go up, they'll go down, values go up, go down. Different political parties will come and go. But one of the things that I remember in real estate is you'll get richer when you have a long-term horizon. And so that's what I kind of want to leave you with is just my last story. And I've used this before, but JC Castillo that we had at the speaker series last month, he owns a management company, but he also buys properties. He bought this property from an investor back about, when Trump was elected. So that would have been 2016 or so. So we bought this property in 2016. He bought a 1938 beautiful In 1938, this was a Class A property, just a beautiful Class A property in 1938. It was still, in 2016, it was a great looking property. So I went to the property, I went to take a look at the deal, and this is a property that is off of White Settlement in Fort Worth. I mean, it's 160 doors that when it was built. Again, 1938, when it was built, it was a Class A building. And I went in to take a look inside the office, and they had kind of what is the box that when people want to put stuff into of historical documents that they kind of hang up on the wall, kind of like a shadow box or something like that. And so this property had a shadow box. It had the architectural plans from 1937. The property was built in 37 and it was opened up in 1938. Again, in 1938, if you wanted to rent a 2-bedroom Class A building in 1938, any idea what rents were in 1938? Any idea?
2-bedroom?
A
Class
2-bedroom.
A, which would be what, $3,000 today?
Yeah. $27
$27
for a month. $27
a month. $27
a month. And so when that property in 2016, the rents probably are $3,000 today, but in there it was like $1,950 or so, $1,950 a month in rent. So it just tells you that if you'll have a long-term horizon, that these properties which were built at this price have gone up exponentially higher. Rents that were at this price back 60, 70 years ago are at this price now. Take the long-term horizon. Don't take these short-term things. Don't get a head fake on that type of stuff. When you invest in the long-term and stay committed. That's it. James, back to you.
All right. Paul, thank you for coming on and dropping some words of wisdom on us. And next up, we've got Mr. Neal Bawa. Let me try to add you to the front here. And so any questions we'll take at the end of Neal's presentation. Neal has put together a great presentation for us tonight. And so put your questions in the chat and we will get to them at the end of his presentation. So Neal, thank you for coming on the show. And we had a conversation, I don't know, probably 4 or 5 months ago.
Yep.
And in sort of building this presentation, and you gave it, and I think you killed it a couple months ago. So I'm just gonna let you do your thing, and we'll come up with some questions at the end. I've got some questions myself, but then any questions that people have, definitely put it in the chat and we will get to them at the end. All right, take it away, Neal.
Sounds good. Firstly, thank you to Paul, to James, and to Julie. It's always fun to engage with the Old Capital people. And I actually, one of my anecdotes is tied to my visit to Peebles and Becker. Both were sitting in a room and we were doing a podcast. Now, I'll give you that anecdote at the right point in the presentation, but it was actually a turning point in my career. A very long time ago. We're talking about many years ago, pre-COVID. And so, it's great to always come back onto the Old Capital podcast and onto the Old Capital, webinar. If I can, James, I do want to share on my side. Is that okay?
Yeah. Let me
right now I can't share, so you gotta give me access.
1 second. Yeah.
Gotta bump me up a little bit. All right. While that's happening, I just want to say the last 2 or 3 slides that Paul had were just pure gold, right? The anecdotes, fantastic, but I have, very, very similar beliefs.
Try your share now.
I'm good. All right. So I have very, very similar beliefs to Paul. But having said that, there are going to be challenges in the marketplace in the next 12 to 18 months. So I present at a conference every year called the Best Ever Conference. It's one of the conferences in our industry. And it was in Salt Lake this year. And I sent them a presentation that was sort of the real estate trends presentation. And then I actually went back to them and said, look, I sent you my whole presentation, but can I do a different presentation? Can I open the conference? Because I was a first speaker after the welcoming, organizer. And I said, can I open the conference with a negative topic? And I know you guys are trying to sell tickets and things like that, but I think this is the year where people need to hear this. Not everyone is in crisis. You know that there's tens of thousands of properties that have fixed rates, and then there's many properties with floating rates that where the rents have gone up so crazy that they're fine. But I do know that there are 2,500 properties in the United States with a DSCR of 1 and below. And the vast majority of these properties are between 150 and 300 units. Where did I get that number? From Yardi Matrix. And I'll show you that number and a bunch of other surprising numbers today. Once I realized that number, I was like, we've got to talk about crisis. And if you don't have crisis, good for you. But there's a huge number of people that have never been part of a cash call. In the questions that James collected, people were like, what's Neal's experience with a cash call? I have been through a cash call in 2015 I believe, on a 237 unit property. And I learned a great deal. And then subsequently, I was asked to advise a friend of mine who was doing a cash call. So basically I had to be there in all of his presentations. I was also the person that investors called on that first cash call that I mentioned. So only 2 instances, luckily, in my life, one for me, one for someone else. But I learned a great deal. And you know what I learned? Most people have no freaking clue on how to do cash calls. They don't even have a concept of what they should do first. And people are going to make mistakes. So I decided, you know what? In case there's a crisis, you should know. Hopefully the worst doesn't happen. But if it does, here's the process. So here for you is a crisis bootcamp. If you have a bleeding property, what should you be doing with regards to cash calls, loan injections, equity injections, recaps, sale at a loss? James and I have collaborated quite a bit on this. And actually one of the quotes that are in here is his. But here's the first thing that I want to tell you. Nearly 30% of all properties that are purchased by syndicators, not everybody, because there's people, billion-dollar corporations buying these with fixed loans, by syndicators using floating debt in the following 3 years, 2020, 2021, and 2022 are now bleeding. This number is based on a small sample size, so I could be off a little bit, but basically what I've done is I've gone around and asked a bunch of my friends, told them I won't name them, I won't say this to anybody else, but could they please tell me what percentage of their properties are bleeding? And people were very candid with me. So I basically made a dozen phone calls, and this is the number that I got, 30%. Now, this doesn't mean that the remaining 70 won't be bleeding at some point in the future. It's very likely that some percentage will be, but this number by itself is really, really bad. Fitch is one of the biggest ratings companies in the US. They're smaller than Moody's, but a lot of companies use them. They're claiming that 23% of CMBS debt, CMBS is one of the big debt sources, smaller than Fannie, smaller than Freddie, but they're a pretty big chunk of the market, that are maturing by the end of this year. So we're talking imminent, right? Will not be refinanceable under any realistic scenario. How much money are we talking about? $6 billion. Basically, that $6 billion is highly distressed. And the only option that I believe is going to exist for that, short of rescue capital, which might rescue maybe 5% of that or 10% of that, short of that, $6 billion of assets. And this is, by the way, this number is only for multifamily, by the way. They have a separate number for office. They have a separate number for retail. That's $6 billion of debt that is going to mature in this year. Now, I don't think any of this is refinanced yet. This is all ahead of us. My friend Ivan Barrett, who was also presenting at Best Ever Conference, gave me this quote. I mean, most syndicators didn't want to even give me a quote, right? But this guy is looking, he's a very candid, very blunt guy. Actually flew to the conference in his plane, so he buys thousands of units. Look at this. In many markets, looking fairly certain that there'll be blood. There's strong potential that a good number of sponsors will have to consider selling for pennies on the dollar versus, and highlight, complete equity vaporization. That's the scenario. That's where we are, right? And here's the data. Everything on this page is from Yardi Matrix. This is updated data. And for many of you, this may be the screenshot slide of this presentation, right? So, we talk about how many properties are in distress. What is the potential distress that we are looking at in the United States? So number one is here's the good stuff, right? These are this is the opportunity, not the distress, right here. There are 3,000 properties in the US, and there's roughly 20,000 large properties. The United States has 105,000 apartments, right? But most of them, as you can imagine, are pretty small. So as we're talking about larger properties, there's 20,000 of them, right? So out of those 20,000 properties, 3,000 have assumable debt loans with 5 to 7 years of duration. And basically, that's what's selling in the market. People's just said it. I mean, our volume is down. Paul, what did you say? Like 78% or 80%, something like that, right?
At
In
least,
that range.
yep.
Yeah,
Right.
80% plus.
80%, right? So what's really selling right now are the properties in the first row, right? Now, what has been acquired in the risk time frame? I call this the risk time frame, 2020, 2021, 2022, with those 2 to 3 year loans, basically we're talking about bridge loans. Well, there's 2,500 properties in there. You know what's interesting? So that number says 2,500. Now look at the bottom line, the ones with the DSCR. Notice that number is the same. It's almost every property in that time frame. It's not 100% correlation, but there's a reason why those two numbers match, right? The total floating variable rate loan, loans that are likely to be at risk, 3,000 properties. Construction loans maturing until 7/24/400. Note that I don't think the crisis is going to be over by July 2024. So that 400 properties, you should sort of bump it up to a couple thousand properties that could be problematic. 300 properties are already in watch list. By the way, if you don't know what a GSE watch list is, it's like, okay, this property is at imminent risk, right? So this is a severe problem. We've got this on a watch list. That's 300 properties. If the average property is $50 million, I mean, just that number is pretty humongous, right? But the big crisis, the real crisis is the last line, right? These are properties where the DSCR at this point is below 1.05. Note that this data was collected in March and interest rates were subsequently raised by the Fed. So that 1.05 is really now 1.0 or less. So these properties are now bleeding. That's a high number. Just so that everyone understands what I'm talking about, okay? 2,500 properties that are $1 million each is 2.5 billion. If they're $10 million each, 2.5 billion. Actually, these properties are about $30 million each. So there's $7.5 billion worth of properties that are in distress. That is a big number. I know it's a big country and multifamily is a big market. Compared to that, this is a small number. I get it. But in and of itself, we're looking at a pretty large number. All right. So, fine, my property is distressed. And by the way, a bunch of your investors, right? So I'm going to give you tips on what to do if you are investors, because in my mind, I'm exactly in the same mind frame as Paul. In fact, James and I are collaborating on potentially buying some of these properties or rescuing them. This is actually a very, very good time to be looking at properties to buy. So if you're an investor, I'll have some nuggets for you. But let me first start with those of you that are equity partners or syndicators, right? So let's talk about what to do first, what to go after next, right? So 9 out of 10 syndicators have never gone through this process. So it's good to have, a list, right? First step is critical. You've got to aggressively cut costs of the property, and you've got to make very clear documented efforts to boost your NOI. This is especially important if the property has zero equity at today's prices. So if there's zero equity at today's prices, right? Now, banks, if they lose money, they have the ability to turn a non-recourse clause into a recourse clause if you don't provide proof of good faith effort. So document every effort, even if they fail, to cut costs and to boost profits. You do not want your non-recourse loan turned into a recourse loan, right? So document. As you're going to do that, basically go to your limited partners, let them know that you need to raise more equity. Now, while you have the right to do a cash call without a PPM addendum, you may actually be able to raise more equity from the outside instead of a cash call. And that does require an addendum if more than a year has passed since the initial raise. Get it signed early in the process. Get an addendum signed allowing you to raise more money from the outside, right? Step 3 might be to loan your own money to stem the bleed. A number of syndicators are doing that. Don't forget that you can charge accrued interest. It is legal for you to charge interest when you're loaning money to the property. If you don't have a lot, put in a little. If there's a lawsuit later, either from your investors or from a bank, that money, that effort is going to help you. Even a little bit matters. It's going to help. Number 4, at that point, sell more equity if you can. Yes, raising money for a bleeding property is hard, but cash calls are harder. Next, ask your bank to relocate your CapEx budget to stem the bleed. In other words, move money to reserves. The first time you ask, the bank is likely to refuse. Most banks refuse. Wait 2 months, ask again. Then wait 2 months and ask for a third time. They'll probably agree the third time. Number 6, consider borrowing money to stem the bleed using your limited partner shares in the property as collateral. The property goes down, your money is lost anyway. You're going to lose all of your money. So what is the harm in using your LP shares in the property as collateral? Borrow money against it. Step 7, borrow money using your general partner shares as collateral. I've done both step 6 and 7, by the way. Note that step 7 is in a gray zone because normally lenders don't like you using your GP shares as collateral, but I'm going to leave it to you to figure out if you should take that risk. Speaking only for myself, I would take that risk as long as I don't give up control of the property. Step 8, cash call. And I have a whole section on that. Step 9, rescue capital. Please note, people are doing this backward. Do not attempt rescue capital until you've tried a cash call. I'll explain why in a few minutes. Step 10, sell the property at up to 100% investor equity loss. Yes, up to 100% investor equity loss. And we'll talk more about that as well. And step 11, which I hope never happens to you, return keys to the bank. Never, never, never be lazy enough to return keys to the bank, even if you think it has $1 of equity. All right. So let's go into the major section. Everything you need to know about cash calls, but we're afraid to ask. First, we're guesstimating that 60 to 70% of all cash calls will fail because of a very few small number of simple mistakes that are actually easy to correct. You don't know, you've never done it. So I'm going to give you 5 rules that'll help you ace your cash call. Rule number 1, the cash call should not come as a surprise. I'm just stunned that people are still telling their investors or implying that they're going to hold to their performas. Come on. They're not that dumb. You're just getting them to stop trusting you. Make sure your cash call doesn't come as a surprise. You should be dropping information about the cash call for months to get your investors ready. Nobody gives you money if it comes as a surprise. The initial reaction is, okay, I'm throwing good money after bad. Prepare them. Number 1, the earlier the better. It takes 3 to 4 months to properly organize a cash call. People are like, I don't need to make a PPM change. Why would it take 3 to 4 months? Please trust me. Both times, it took longer than 3 to 4 months. So I'm just giving you the benefit of the doubt that you're super fast. Well, if you're super fast, it's going to take you 3 to 4 months. Number 3, this is the most important one. When people say no, they don't mean no. That is an initial reaction. When they say no, it is your job to call them up one at a time. Well, you were fine with doing that when you bought the property. Why can't you call them personally and ask for money? There is an element of embarrassing people into helping you. They're helping you. They're helping the other investors. You've got to basically make it difficult on them. You've got to be in their face. I made phone calls to 60 investors in 2015. 60. That wasn't 60 phone calls, by the way. That was about 150 phone calls because not everybody picks up the phone when you call them. Some people are actually trying to avoid you. Rule number 4, ask for twice what you need, but never ask for more than 40% of the original equity investment. So if people invested 100 grand, don't ask for them for more than 40,000. That doesn't seem to work. But otherwise, let's say you need $10,000 an investor, ask for 20 because not everyone's going to give it to you. So ask for twice what you need. Rule number 5, don't forget rule number 4. Please don't ask for what you need. You're never going to get exactly what you need. So you've got to take that number and double it. All right, so now that I've given you those 5 rules, I'm going to give you the essentials of a successful cash call. Number 1, start by proving to investors that this is good money. It's not bad money. Address the issue up front. You have to find a way to address it. I can't do that for you because every property is different. Make them understand the fundamentals. Number 1 is always remind them that the fundamentals of multifamily are the strongest of any commercial asset class. No other asset class, whether it's industrial, self-storage, retail, or office, is anywhere close to multifamily at this point. We've seen all this interest rate hikes. We've seen all this slowing down of the economy, and we've dropped from a 95.5% occupancy rate to a 94.5% occupancy rate. Explain to them how robust the market is. Number 2, ask for their help. I am a LP investor in 26 properties. And I think 23 of those are multifamily. 3 of those have had cash calls or the starting of the cash call process. 2 of those two of those syndicators were almost rude when asking for the money. You're asking for other people's help. You can't be talking about your amazing track record and the fact that you gave them so much money before. That rubs people the wrong way, right? So I think be a little bit humble. Remind them that they've benefited from the partnership before, but do it in a way that it has some humility in it. Compare. Every other property that they invest in today is very likely to suffer from the same problems. Remind them that this is a endemic issue. This is a pandemic issue. This is an issue basically affecting the entire industry at this point of time, right? It's a very small number of properties that have escaped this. They need to believe that first. Support. Show them that you're investing in more into the cash call yourself. You will not succeed in a cash call if you're unable to invest into it. You have to find the money from somewhere. Beg, borrow, or steal. Number 5, connect. Call every investor that does not commit one-on-one and ask for their help. Call them and say, I need your help. I can't do this without you, right? This is not good money after bad. Everything has risk. Everything has risk. Look at what happened with the stock market. Did you foresee that your Tesla stock could go down 70%? Did you see that Netflix went down 80%? This is happening to everyone. It's happening in every area. We believe we can recover. We believe we can recover your money. We can recover your existing cash and the new cash that you're giving us. Call every single one. That's how I got most of the money in 2015. Now, I'm going to go into the convince them that they're not throwing good at money after bad, Pete. Here's the example of a perfect pitch for a property. Tell them, if interest rates had not risen, our property would be today, based on its current numbers, distributing X% cash. And the property would be Y% above pro forma. Maybe it's not above pro forma. Maybe it's at pro forma. Maybe it's even slightly below, right? And IRR, our property would be at Z% IRR if interest rates were at A% today. So what you're doing basically is you're looking at the property's current performance and saying, if interest rates were here, 4.5, whatever you feel comfortable with, this is what my property would look like. You might say, oh, this is common sense. Come on. Do you think your investors know how to do the math? It's your job to do that math. Take the interest rate out of the equation, present it to them, and they will instantly see that the problem is the interest rates. Most importantly, see that part on the bottom? Show them. Don't tell them, show them. PowerPoint slides. You made 100 of those slides when you sold this when you pitched this property to them. Why can't you make 2 slides about where the property would have been if interest rates were not high? Here are some boosters. I'm going to give you some boosters. These are optional, but I recommend them a great deal. I've used all of them. Booster number 1, if the cash call is failing, offer to take cash call money from hesitant investors as a loan to the property rather than equity. Loans get paid before equity. And I know this is gray. There's challenges here. You're trying to save the property. It's not illegal. Booster 2, offer to cross-collateralize the cash call money with GP shares from another property. I already know of 3 general partners that have done this or offered to do this. Obviously, that other property can't be bleeding, right? So, maybe you have a property that's, not bleeding, or, it doesn't have to be distributing cash, but it's a property that doesn't have bleed. Cross-collateralize the cash call money with GP shares from another property. Once again, you are not obligated by law to do this with all investors. Maybe you have a major investor. You know he has money, but he won't give it to you until he gets something out of it. Cross-collateralize those GP shares, get his money in. Number 3, offer to accept lower amounts from investors or give them more time. So if the investor put in 100 grand and the cash call is $30,000, they don't do 30, take 25, take 20, take 15, take any amount. It's legal, it's ethical. Don't get caught up in this whole, is this the right thing to do? You're still trying to save their property. How long does it take? These are your steps. 2 weeks to prepare a truly compelling webinar slide deck and invite investors. Please note that because this is a cash call, you need to show the deck to your lawyer first. You spend a lot of time with that beautiful deck that you designed years ago when you bought this property. It's also time for you to design a webinar slide deck now.
नहीं वो कृषि के नहीं है, कृषि के नहीं है, आप
We got someone that needs to be muted. All right, there we go. Offer your Calendly link during the webinar for one-on-one calls. They want to call you, and yes, they're going to say some things that are problematic. I had 2 investors that cussed me out of 60. They should have all cussed me out. They didn't. It's not as bad as you think it's going to be. Most of them are actually quite sympathetic. They still need to talk with you. Make all calls in the week after the webinar. Don't wait. As soon as you do the webinar, you have only one job in life at that point, to make phone calls. And keep reminding investors in the coming weeks to pay. Tell them other people are coming in. Every time you get money from an investor, say, hey, we just got 100,000. We just got 75. We got 200,000. Text them. And remember, it takes several months for the cash to come in. So you basically got to have the time. Please don't start a cash call 8 weeks before you're going to default. And I'll end this cash call section by giving you 5 powerful statements. You're going to make these statements over and over again to individual investors and to on the webinar.
Talk about
right?
Seeing justified, but they've got to be on one side.
Well, all right, there we go. So all 5 of these should be used in some way in your email invite that you're sending out for that webinar, in your deck, and in your words during your cash call. But please don't just say them, actually believe them. Say, your help is critical to our success. Multifamily is a business, and you are a partner in this business. All of your cash call money will go towards protecting and growing your original equity. We're staking our reputation on getting your equity out safely and making the project profitable again. Don't confuse this with 2008. Banks want to lend, investors want to invest, and buyers want to buy. All 5 of these statements are completely true. Believe them, say them, you'll have 3x the outcome, I promise you. All right, moving on. That was cash calls. Happy to take questions, by the way. Rescue capital. Does it really exist? Some people call this pref equity, some call it rescue funds, some call it, there's just a million names for it. Basically, this is money that's coming in to rescue you. There's 2 kinds of rescue capital that is available or is going to be available. On the left is refinance rescue capital, which essentially is money that comes in, right, into the property, and they take away some or all of your GP power, and they take away some or all of your LPs prefs, and sometimes basically even say things like, well, we can only return 50% of your investor equity, regardless of what happens to the property. So there's different levels of them. Some are more sharky, some are less sharky. And so the ones on the left, they come in and they refinance to perm, right? Or some kind of loan that's different from what you have, the loan that's bleeding. 5-year fixed debt is pretty common. Paul was talking about that. And all rescue capital is expensive, right? Typical checks, 3 million, 5 million is what I'm seeing in the industry. And they're commonly structured as pref equity, right? Some sort of pref equity that comes in above your investors. Now, on the right side is an interesting thing that we're hearing more about now in the last month. This basically doesn't refinance your property. It helps you keep your property afloat with cash. So they're basically giving you bleed to help you get to 2025. Remember, what's the multifamily market's mantra? Survive to 2025, right? It was even in James Zheng's quote that's coming up in a few slides here, survive to 2025. Well, these kinds of groups believe in your property, they think you've got a great property, but they don't see a path to refinance at this point in time for various reasons. So they basically just give you the bleed. This only works if your bleed is more reasonable. If your bleed is $300,000 a month, nobody's going to give you that. If your bleed is $50,000 a month and you truly don't have that money, yeah, sure, there's plenty of groups that'll give you this money. You notice that this kind of money is smaller. Hopefully the bleed's low. So 1 million, 3 million, those kinds of things. These are actually structured differently. Most of them are convertible notes. Essentially, it's a loan that can convert into equity once certain performance benchmarks are hit by you or by the property. Now, what about costs? What I'm hearing is 8% plus 10%. Now, obviously, if it's bleed, that 8% is going to be accrued because your property is bleeding, they haven't refinanced it. Where's that money going to come from? So it's all going to be accrued, right? So it's really 8% accrued and 10% accrued. But if they're refinancing the property, then they want 6 to 8% upfront. And you might say, "Oh, that is the property really going to start cash flowing that much?" Yes, because they're not going to give anything to your investors. They're going to keep all the cash flow. And because the property might have $12 million of investors already, if they put in another $4 million to help you refinance, well, it only has to make 8% on that 4%, on that 4 million. It doesn't have to make any money for the remaining $12 million worth of investors. So it's possible to get to 6% or 8% cash flow for them, the people that are coming in, right? Now, a bunch of you have told me this. We've heard at NMHC that rescue capital is available at 6%. Please read the right side. They also said at NMHC that this is available for people with very large track records, 10,000 units, huge skin in the game, people with $50, $100 million balance sheets. If you're one of those, good news, you can get 6 plus 6. For the rest of us, it's probably 8 plus 10. How to improve your chances of getting rescue capital? Start early. Rescue capital isn't going around announcing that they're doing it, except for me. I guess I'm the dumbest one. So start early. It takes time to find them. It takes time to negotiate. Everybody that's come to me, I've sent them away. Why? Because they haven't done their cash call yet. I said, there's no way your LPs are going to agree to my terms unless your cash call is unsuccessful. And if your cash call succeeds, we'll never talk to each other again. Good for you. Second, please be honest with yourself. Do you have any equity in the property? I mean, it's very difficult to get capital if your property has no equity based on today's value. No equity. A little bit helps because we all know that cap rates will recompress when rates go down. We don't know when. So at some unknown point in the future, we believe that cap rates will recompress. If you don't believe they're recompressing, what the heck are you doing listening to me anyway? Why are you in here, right? Run. I think everyone believes that. So a little bit of equity, you've still got a chance. If you have no equity at today's numbers, that's going to be very challenging. Remember, cross-collateralize your GP shares. If you have substantial GP equity in other performing properties, you can cross-collateralize to get rescue capital. This is very important. If you don't understand this, ask me questions. So here's my rescue capital or recap fund. We're currently engaged with 3 different properties. So check sizes are up. One of those properties, by the way, we're looking to do bleed, but we think that property just makes sense for us to keep giving them bleed. It's a syndicator that has no money, but the property is bleeding a very small amount of time and has has a substantial amount of equity in it. So it does, at this point, it just makes sense to pay the bleed at there. But the other 2, we're gonna, if they agree to our terms, then we'll bring them to James Eng to do a refinance to perm debt. So we're our cap is 5 million. We're not doing check size higher than that. If there's no equity in today's cap rates, we're not pursuing. Primary focus is basically to refi, but we'll also look at bleed. Secondary focus is that bleed, and that's rare situations. Most properties don't qualify for it. How many rescue capital requests are we receiving? January was 1 in the whole month. Feb was 1 per week. March was 1 per day. April was also 1 per day. Okay. Done with rescue capital. Last portion, dealing with your bank, what you need to know. Now, before I do that though, you're only in this room because everyone knows that there's a huge, huge shortage. There's a massive shortage of multifamily. And if you listen to Paul, you understand that shortage will get worse because new construction projects are slowing down. Some are becoming smaller. Some are basically simply just sitting there on the sidelines because the numbers don't pencil out. I've been building, I'm like most of you. I do lots of value add properties. I love them. I want to continue doing them. I need the depreciation because my taxes are high. But I also understand that value add is much riskier than it used to be 5-6 years ago when I was, when I was starting. Well, more like 10 years ago when I was starting. And so a long time ago, I was like, when you value add a property, it's an occupied property and you improve it, and then basically another tenant goes in. So all you're doing is making the property better. But in the end, you're not adding to the nation's stock. And I wanted to add to the nation's stock. So I went off into development and I built a bunch of apartments. I built student housing, I built apartments, I built all kinds of assets. And then I was like, yeah, but what I really want is to give people a home to live in. So I started to build townhomes. And I went off in the wrong direction. I went off in the direction that Peebles told me not to go into, right? He said, new construction is expensive, Neal. You're not really solving anybody's problem. Basically, the only people that will afford your properties, whether it's expensive Class A apartments or these kinds of townhomes like the one you see on the screen, are basically renters by choice. For whatever reason, they don't want to buy something, so they want to live in a Class A apartment complex. Then they see your beautiful townhome, they go live in there. How is that solving America's problem? And I didn't listen to him back then. But years later, I realized that he was right. And by the way, his comment came when I was doing the podcast in his office in Dallas. So after years of building even more expensive ones, you see those on the right? I realized I needed to find markets in the United States where I could build ultra cheap, high quality townhomes. And I mean ultra cheap. I mean $1,600 in rent for 3-bed, 2.5 bath, granite countertops, new construction, 1-car garage. That became my obsession. And I went around the United States and paid for lots and lots of people for data, John Burns, Ivy Zellman, a bunch of people for data. And I found 9 markets in the United States out of 300. There are 358 markets in the United States that are called metro MSAs. Almost every one of them I failed in. But there were 9 markets in the United States where I built that product. It's in the center. And guess what? That product was the most profitable product I've ever built in, had no leasing issues, and we have 5-month wait lists. I was successful. I was able to build housing stock for the United States that's non-subsidized, not affordable housing, 1,650 units. Every single person that is listening to me is welcome to come to a tour. I go there every 6 weeks to tour my partners and investors. Every single person, including someone I took last weekend who's 82 years old and has been a syndicator for 23 years. For 23 years, he became a syndicator in 1999. He said, this is the most unique product in the United States. It actually fixes a problem. No one wants to live in apartments. They live there because they can't buy single family homes. And as you all know, tens of millions of Americans are never going to be able to buy these homes. So I build ultra cheap townhomes in tertiary markets. That has become my mission. I love value adds and I'll keep doing them, but that's not my mission. My mission is to build 10,000 rental townhomes in the next 10 years for middle America. Note how specific I am, with rents only from $1,500 to $2,000 a month to serve families earning $54,000 to $72,000. That is my mission. And I only do those projects that make a minimum of 25% for my investors on an annualized basis, a minimum of 2x equity, but a lot of them make 2.75x. This took me forever, but I'm a data scientist and I'm very bullheaded. I kept going at it and I found 9 markets that work. It's already done. I've already done this from beginning to end, 100% occupied, 6-month wait lists. Come audit me. I need to scale it. That's why I'm here. I'm really not looking that much for investors. I'm looking for partners that believe in my mission, Mission 10,000. And they want to figure out how I solve middle America's problem. Once again, these are not apartments. I'm not interested in, at this point, in building apartments. I think that's a wonderful thing. If you're building apartments, God bless you. Middle America doesn't want to live in apartments. They want to live in a home. And I know I can't build single family homes at that rent, but I can build townhomes in 9 markets in the United States. So if you're interested in being anything, an equity partner, an investor, a construction partner, just type Mission 10,000 into the chat box and I'll prove to you that this works. Mission 10,000. All right, let's finish up. Dealing with the bank. The first thing you need to know is what James Zank thinks. Here is the quote that we showed off at the best ever conference, right? Survive to 24. These are amazing words, right? Get your existing portfolio in order. Extend loan maturities. Try everything. Refinancing. Move from float to fixed. Extend rate caps. Get monthly positive cash flow somehow. It's possible, right? There'll be plenty of bargains coming in the next 12 months. I believe that. He believes that. Paul believes that. But you won't be able to buy them if you don't make the tough calls on your existing portfolio now. Make sure your ass is on fire right now to get this done. And by the way, don't wait for interest rates to come down. I keep hearing from syndicators saying, we're just going to wait for interest rates to come down. It takes a long freaking time for that to happen, much longer than you think. Note this. Why are banks not afraid to take your properties? Number one, there is no evidence of contagion, and there probably won't be any. Number two, buyers are easy to find. At the right price, banks can sell your properties in 24 hours. Property value at today's cap rates are typically higher than the senior debt. This isn't true for all properties. You just saw a $200 million example where Arbor lost 32 million. But many of the properties that are in that 2,500 range, even at today's cap rates, the property value is slightly higher than what the senior debt is. And if that's the case, they don't give a damn. Number four, they know that you will sell if all else fails. That's why they are not afraid to take your property back, because they know at the last moment you're going to sell it anyway. What's possible and what's not with bank renegotiation? What's possible currently? Reallocation of capital budget. Go talk to them, they will say no. Go talk again, they'll say no. Go talk again, most likely they'll say yes. What's not possible yet? I haven't heard of this, and please educate me if I'm wrong. We have not seen any bank in the US do principal deferment or payment deferment or a temporary rate adjustment. If you've seen that happen, please let me know. I need to know. All right, so wouldn't a bank put the property on the market for sale after they take it back? This is a common misconception. Hey, they're just gonna take the property back and put it on sale. I'll still get my investors' money back because the bank has to sell it there. That's rubbish. Total and utter rubbish. They can do that, but they don't have a legal obligation to get the maximum price. So they will often accept cash offers. I mean, Ken McElroy will walk into their office and say, I will buy this property for 5% more than your senior debt. This shouldn't be legal. Technically, it isn't even legal. Banks do it all the time. Get your head in the right place. They have no interest in your property. They just want their money back. So number one, don't expect the bank to sell the property for full value. Once your property goes back to the bank, expect to lose either most or all of your investor equity. If there's any investor equity in this property, the only one that can protect it is you. Don't expect the bank to protect it. All right, last two slides. Sell at a loss. You're going to be helping your investors if you sell at a loss. Here's an industry superstar. Most of you know him, but he wasn't willing to let me use his name. The biggest mistake that syndicators are likely to make is to wait too long to sell their building. Don't let your ego get in the way of a smart decision. If your cash call and your rescue capital efforts didn't work, don't burn down the investor equity to zero. Sell, because quarters and dimes are better than non-existent dollars. Wise words. So, if you can't get to 2025, waiting doesn't help. It hurts. I wouldn't say that anymore. So this was true in the last 6 months. I believe that at this point, rates may stabilize for the next 3 or 4 months, maybe even 6 months. But please note, the economy is at 3.4% unemployment. The banking crisis has subsided. There is zero pressure on the Federal Reserve to drop rates. There's a great deal of pressure on them to stop raising them. There's zero pressure on the Fed to drop rates with an economy at 3.4%. Remember, they want unemployment at 5%. It's going to take a long time to get it from 3.4 to 5. Spread compression is also unlikely to help. We keep hearing that, hey, bridge spreads could compress. I agree, bridge spreads will compress. They're based on, right now, banks are basically being very careful about having huge spreads, but I don't think that happens until late Q4. It might not even happen until Q1. So remember that. Number 4, don't compete with other distressed properties. James and I have started to believe that it may be too early at this point in time for rescue capital. We need to see a substantial number of properties My math says we'll see them in Q4. Do you want to compete with distressed properties in Q4? So here's a mantra I have for you. I will protect every property that I have from default, and I will not let my ego get in the way of selling a property at loss to save some of my investors' equity. And that's it. I'm ready for your questions.
All right, Neil. I was still taking notes here on my side, even though I've seen this presentation a couple times, and you sent me the deck. So I appreciate you going through it. Any questions? Put it in the chat. But I had a bunch of people send in questions beforehand, so I'll get it started, and then we'll try to do this. I know you've got a short amount of time, so we'll try to make this as quick. Probably I don't know what to call it, quick fire round or something.
Sounds good.
Okay, here we go. So I'm going to start from the GP perspective. So David asked, are capital calls a reputation killer to operators?
They are. Losing a property is the end of your career. Which one do you like? Which one would you want? A reputation hit that you can survive, or an event that takes away your career? I think the choice is clear.
All right. The second question. All right. Do GPs?
By the way, James, before you do the second question,
Yeah.
I'm joining from my iPad. As you know, I have to leave for an evening event. So just so you know that you'll see two Neils. Okay.
No worries.
That second, at some point, I'll just switch over. My audio will still work fine.
Okay. No worries.
Okay.
All right.
All right. Keep going.
Yep. All right. The Brian asked, do GPs take a haircut in their equity when doing capital calls?
It's not required. There's no requirement for you to take a cut in your equity. Whoops. I'm going to mute this one. So it's certainly not required. You don't need to take a cut, but it's also not unusual to offer something.
Okay. So you mentioned your capital call. You had a couple capital calls. Is there anything that you would have done differently in those capital calls?
Yeah, I mean, I discussed all of those with you, right? So, hang on, are you hearing an echo?
You're okay.
Okay, that's fine. Okay, so I think everything that I would have done differently, I told you already. Stuff like, I asked them about the amount of money I actually needed. That was dumb. Not everybody gave you that money. I also initially believed that if they said no in the webinar, that wouldn't work. But I got more and more desperate. I needed it. And when I started making the phone calls, that's when the majority of the money came in. The webinars are great to sell shares. They're not great to do cash calls.
Okay. Okay. So Travis asks, how would you recommend handling capital calls that fall short of the full raise?
Any amount of capital that you rail is going to help. So, I mean, maybe I don't understand the question. I mean, the truth is, any amount that you get is going to help you.
Okay, so let's say, yeah, you're trying to raise $2 million and then you only get to $1 million. Do you keep the money and try to keep going, or do you return the money? It seems like you would just keep the money, right? At that point.
Under no circumstance, return the money.
Okay.
You need that money at that point. I mean, whatever your eventual solution is, even if it's rescue capital, that by the way, when you go to rescue capital, don't tell them you've raised $1 million. Tell them, I'm confident my investors will give you $1 million, and then show up with that $1 million. Now they're like, oh yeah, this guy's investors like him. That's good.
Okay, so
I know that's like, oh my God, he's nasty. No, I'm just trying to help my investors.
So what Johnny asks, what are the typical strategies the GP deploys after the capital call? So what's usually the money going towards on these capital calls?
One is refinance. right? So you're using the money to refinance. The second one is, if you remember James Eng's quote, right? Buy rate caps. I mean, rate caps are time limited, but who knows? I mean, sometimes at least it'll get you a year, and maybe it'll get you 2. Who knows?
Okay. All right. Not me. Another James asked, what's the number one way to screw up a cash call?
Oh, I gave you a big list.
Number one way,
think-
I guess.
I'm gonna pick the ones that are sort of the big mistakes, right?
Okay.
So here, in this list, this one right here, rule number 3.
Can you read it off? I think I switched.
When
it.
people say no, they don't mean no.
Okay. So they're gonna say no by no action at first, and then you're
Yeah.
gonna have to call them to take action.
Not just call them, push them,
Okay.
nudge them, beg them.
All right. So this
Shame
all
is
right.
a powerful motivator.
All right. So those were all from the GP side. Now I want to go over to the LP side.
Mhm.
So these came from limited partners. And so Chris asks, how do I decide I'm not just throwing more money, so bad money after good money?
You need to do more due diligence during the cash call on this syndicator. Basically say, I want a meeting with you one-on-one, and I want to be in a Zoom call. And I want you to prove to me how this money is going to get used. Now, most syndicators will say, no, I can't prove it to you. But here's what's going to happen as they go through that process. That'll give you either confidence or a severe lack of confidence on their ability to save the property. So ask for a one-on-one meeting, sidebar, and you say, just walk me through everything. What are you going to do with my money?
Okay. So maybe the valuation of the property, where the money's going to go, the debt service, how's this money changing this property? How's it
Yes,
fixing this
show
property?
me everything.
Okay. Steve asks, what are some pitfalls that limited partners should look out for when adding additional capital to a deal?
I think the same answer that I just gave you really applies.
Okay.
There's a few additional ones. If they start talking about pref equity, they're getting pref equity. Tell them, I need to know the terms before I give you money. What if the terms of the pref equity said 80% of your existing equity gets wiped out? Well, in that case, 80% of the money you are just giving to them is also going to get wiped out.
Right.
Right? See the terms.
Okay. So I think you covered this, but Celissa asked, what are the average percentages of their, I guess, original investment that LPs are being asked to contribute during these capital calls? And then what is a concerning percentage?
Any percentage is concerning. But I think the answer is, if they're asking you to contribute 40, 50%, their chances are pretty low.
Okay, just too much at
Yeah.
that point. Okay. Dhruv asks, what happens if the LP decides just not to participate?
In most cases, nothing happens. You just get diluted, and that dilution is usually worth it. But there are some syndicators that have punitive clauses in the PPM that says that if you don't contribute to a cash call, the equity that's in there automatically dilutes, and not on a one-to-one basis. Basically, it's punitive dilution. So figure out and ask the syndicator, do you have a clause that's not regular dilution? Is it a punitive dilution clause? If they say yes, we have one, immediately ask for that clause and tell them, explain this clause to me.
On the next question is on the, I guess you said you got 3 capital calls as an LP. Did
Yes.
you contribute?
Well,
to
2,
the,
but
2.
one potential call.
Okay, so let's say
Um,
2. On
mhm.
those 2, did you contribute, and why or why not?
I contributed to one because I asked myself the question, if I was a syndicator, can I save this property? And the answer is yes,
Okay.
right? The other one, same answer. I mean, I looked at the numbers and I said, their chances are maybe 1 in 10, 1 in 20. I mean, I've never gambled in Vegas. 1 in 10, 1 in 20. I think I would do better at a slot machine.
The slot machine or blackjack? Come on.
Blackjack works all the time. Yeah.
All right. So Gareth asked, and I'm not sure where this exactly was going, and I don't know if it's a GP or LP question, but I like the question. What is the easiest trap to unknowingly fall in?
Geez,
I
I
don't
think
know.
that's too wide a question. I'm going to pass.
I know
on
it's
that.
too wide, but let's just go from the LP perspective. Is
Yeah,
there
well,
something that
I think the big trap is
Yeah.
that you're not being numbers driven, right? So they're like, we think we can save the property. Let's go, let's go, let's go. No, show me what you're going to do with the money, every cent. How are you going to save my property? That's the big trap, right? Because, you know, I gave you all of the 5 emotion driven things that you as a syndicator are going to say. Now your syndicator is going to take my PowerPoint slide and use it against you as an LP. So
Right.
be careful.
Okay. Next question says, should an LP accept an offer to become a co-GP during a capital call?
It's very likely most pref equity people will dilute your general partnership capability. So they will want to do that. I mean, it's just going to happen. So if the GP is not ready to do that, and you know that as an LP, go yell at them.
Right. Okay. So this person, Dinesh asks, why can't the GP just put their acquisition fee back into the deal instead of a capital call?
It's not going to resolve anything. The acquisition fee is tiny compared to the amount of money that they need to raise. Also, regardless of what the performance of the property has been for the last 2 or 3 years, that acquisition fee was used by the syndicator either to pay their employees or to pay themselves. It's long gone. I don't think it comes back. There are a few syndicators that are doing it. I don't think it's an expectation that you should have.
Okay. Samuel asked, where is the best place, if there is even such a place, to see which deals have had capital calls?
There's no such place.
There's no such place. Okay.
James and I would like to figure it out.
Yeah, so I would love to have that, but those are all the questions that I pulled down prior. That was, the just
Perfect timing. It's 5:30 PST.
Yeah. So Neal, we appreciate you coming on. I will definitely have to rewatch and listen to again, because the deals that I've been a part of, there's only been one capital call. And
they're all in front of us.
Yeah, it's all in front of us.
There's going to be a massive number of them coming, right?
Yeah.
So it's just a matter of time. So one thing I wanted to mention, those of you that are interested in Mission 10,000, please feel free to reach out to me. If you set it in chat, I will get, that information from James, just hopefully you said Mission 10,000. Please reach out to me. What I'm doing is extremely exciting. If a syndicator who did it for 22 years and is 81 years old thinks that no one else in the US is doing this, it's worth you looking at. And the truth is, many of you that are equity partners, you need options right now.
All right, Neal, thank you for coming on. The presentation, even though this is the second time I've heard it, is still, it seems like it gets better every time. So thank you very much. And we'll let Neal get to his event that he has scheduled for later on tonight.